If you've got some extra money sitting around and you're not sure what to do with it, this video is for you. Investing can feel overwhelming at first. There's a lot of jargon, a lot of conflicting opinions, and it's hard to know where to begin. Today I want to cut through all of that and give you a clear, grounded introduction. What investing is, why it matters, and exactly how to get started. By the end of this video, you'll have everything you need to make your first investment and build a habit that can genuinely change your financial future. We're covering 7 things today: why we invest, why stocks specifically, how to open an account, what to actually buy, when to invest, how to stay consistent over time, and how to think about your own goals and risk tolerance. Let's get into it. So, why do we invest? There are 2 core reasons to invest rather than leave your money sitting in a bank account. The first is inflation. Every year, the purchasing power of your money quietly decreases. The U.S. Federal Reserve targets an inflation rate of around 2 to 3% annually, and you feel it in everyday life. Things that cost $8 a few years ago cost $12 today. The same amount of money simply buys less over time. If your savings are parked in a standard checking account earning near zero interest, inflation is effectively shrinking your wealth each year without you doing anything wrong. Investing is how you stay ahead of it. The stock market has historically returned around 8 to 10% per year over long periods, well above the rate of inflation. The second reason is compound growth, and this one is worth really understanding. $1,000 and it earns 10% in year 1. That's $100, not life-changing on its own. But in year 2, you don't earn 10% on your original $1,000. You earn 10% on $1,100, because last year's gains are now part of your balance. Your money earns returns on its returns. Let that run for 20 years without adding a single dollar, and that original $1,000 grows to nearly $6,800. The money multiplied on its own. Now scale it up. $1 million at 10% annually generates $100,000 a year, just from letting it sit there. Nothing about the math changed. Only the starting number did. That's the real reason people talk about building wealth through investing. The more you have working for you, the faster it compounds. Getting started early, even with a small amount, is more powerful than waiting until you have more. Number 2, why stocks? There are plenty of ways to invest: real estate, gold, collectibles, cryptocurrency. So why focus on stocks? 3 reasons: accessibility, liquidity, and historical consistency. Stocks are accessible. You don't need a lot of money to start, and you don't need a broker or financial advisor. You can open an account online today and make your first investment within the hour. Stocks are liquid. That means you can convert them back to cash quickly and easily. If you own a house and need that money back next week, you have a real problem. Selling real estate takes weeks, involves fees, and requires finding a buyer. But if you own a stock, you can sell it the same day and have the cash in your account almost immediately. And over long time horizons, stocks have been remarkably consistent. The S&P 500, an index tracking the 500 largest U.S. companies, has dipped, crashed, and recovered more times than most people realize, but the overall direction over decades has been upward. To put a number on it, $100 invested in a broad market index fund in 1980 would be worth over $17,000 today. Adjusted for inflation, $100 in 1980 has the purchasing power of about $390 now. Your investment still grew 44 times beyond inflation. That's not a trick or an anomaly. That's what staying invested over time can do. Number 3, how do you actually invest? To buy stocks, you need an investment account. Think of it like a bank account, but designed specifically for buying and holding investments. There are 2 main types to know about. The first is a retirement account. In the U.S., the most common versions are a 401k, offered through your employer, and an IRA, which you open independently. Both come with meaningful tax advantages, but the trade-off is that your money is generally locked up until retirement age. Withdraw early and you'll face penalties. Some people appreciate the discipline that constraint creates. Others want more flexibility. The second type is a regular brokerage account. No special tax benefits, but no restrictions on when you can access your money either. You pay taxes on gains when you sell, but it's otherwise simple and straightforward. A sensible starting point for most people. Take advantage of any retirement account your employer offers, especially if they match contributions. That match is essentially free money. Then, open a regular brokerage account for any additional investing you want to do. As for where to open your account, platforms like Fidelity, Charles Schwab, and Robinhood all make it easy to get started online. The interfaces differ, but the core function is the same. Number 4. What should you invest in? Once your account is open, the question becomes, what do you actually buy? You could buy individual stocks, shares of a single company like Apple, Microsoft, or Amazon. This can work well if you do the research and have a tolerance for volatility. Pick the right company, and you can significantly outperform the broader market. But pick poorly, and the losses can be steep. For most people starting out, a better option is index funds and ETFs. Here's how they work. A mutual fund pools money from many investors and hires a professional manager to pick stocks. The manager charges a fee for this service, and those fees quietly reduce your returns over time. An index fund does something simpler. Instead of a manager making active decisions, it automatically tracks a market index, like the S&P 500. No human stock picking, no high fees. It just holds every company in that index, weighted by size. An ETF, exchange-traded fund, works similarly. The two terms get used interchangeably, and for our purposes today, you can treat them the same way. When you buy one share of an S&P 500 index fund, you instantly own a small piece of 500 companies: Apple, Microsoft, Amazon, Nvidia, and hundreds more. You're diversified from the moment you buy in. One company having a terrible year barely affects your overall portfolio. The fees are also extremely low, often less than a fraction of a percent annually, because there's no management team to pay. A few ticker symbols worth knowing. VOO is the Vanguard S&P 500 ETF. SPY is another popular S&P 500 fund. QQQ tracks the NASDAQ, which skews more heavily toward technology companies. Think of ticker symbols like airport codes. Once you know them, you can find the investment instantly on any platform. For most long-term investors, a broad market index fund is the single most reliable, low-maintenance place to start. Number 5. When should you invest? This is one of the most common questions beginners ask. Is now the right time? What if the market is too high? Here's something worth knowing. The S&P 500 spends roughly 8% of all trading days at all-time highs, about 20 days per year at a record level. And historically, new all-time highs are often followed by more all-time highs, not crashes. Research shows that if you missed just the 10 best market days over the past 30 years, you would have erased more than half your total returns. Missing 20 of those days costs you nearly 3/4 of your gains. The problem is, those big days are impossible to predict, and they tend to arrive right after periods of fear, when most people are tempted to wait on the sidelines. Financial writer Nick Maggiulli makes a compelling case in a piece called "Just Keep Buying." His argument: rather than waiting for the perfect entry point, the better approach is to invest consistently, regardless of where the market sits. Time in the market consistently outperforms attempts to time the market. He uses the PE ratio to illustrate this, price to earnings, a measure of how expensive stocks are relative to what companies actually earn. When PE ratios are high, short-term future returns tend to be lower. That part is intuitive. But here's the key finding. Over 20 and 30-year periods, even investors who bought at peak valuations ended up with strong, positive returns. Over any 20-year period in U.S. market history, stocks have never delivered a negative real return when dividends are included. In 2012, many analysts argued the market was overvalued by 50%. If you had listened and stayed out, you would have missed the market more than quadrupling from that point to today. The takeaway isn't that valuations don't matter at all. It's that for long-term investors, finding the perfect entry point is far less important than simply getting in and staying consistent. Number 6. Dollar cost averaging. Once you've decided to invest, you have a choice in how you actually deploy your money. You can invest it all at once, called lump sum investing, or spread it out over time, which is called dollar cost averaging. Lump sum investing actually outperforms dollar cost averaging about 2/3 of the time, mathematically speaking. Markets tend to rise over time, so money invested earlier has more time to compound. If you have a large sum ready and a long time horizon, Putting it all in at once is often the better pure math choice. But math and behavior are two different things. Dollar cost averaging has a real psychological advantage. It removes the pressure of timing and reduces the anxiety of watching a large investment immediately drop in value. Here's how it works. Instead of investing $12,000 all at once, you invest $1,000 every month for 12 months. When prices are high, your fixed amount buys fewer shares. When prices dip, that same amount buys more. Over time, your average purchase price smooths out. You're not trying to find the bottom. You're participating steadily regardless of where prices are. The deeper benefit is that it turns investing into a habit rather than a decision. You set up an automatic recurring transfer once, and it runs in the background. You stop asking, "Should I invest this month?" and it just happens. That consistency, compounded over years, is what actually builds wealth. Most brokerage platforms let you set up recurring investments easily, weekly, bi-weekly, or monthly, in whatever amount works for your budget. Set it up once and let it run. Here's what consistency can look like in practice. If you invest $500 a month into an S&P 500 index fund, earning an average annual return of 8%, after 35 years, your total contributions of around $210,000 would grow to well over $1 million. The majority of that growth isn't from what you put in. It's from decades of compound returns working quietly in the background. Number 7, your goals and risk tolerance. Before we wrap up, there's one more thing worth thinking about: understanding yourself as an investor. The right strategy isn't the same for everyone. It depends on your goals, your timeline, and how you genuinely handle uncertainty. Risk tolerance is your ability to stay calm when your portfolio loses value, and at some point, it will. Markets have bad years. In 2008, the S&P 500 fell around 37%. In early 2020, it dropped nearly 34% in a matter of weeks. If you would panic and sell everything in a scenario like that, that's important information. A more conservative allocation might serve you better than one that's theoretically optimal. Time horizon matters just as much. If you're investing for a retirement that's 30 years away, you can afford to take on more risk. You have time to recover from downturns and let compounding run. A portfolio weighted heavily towards stocks makes sense. If you're within 5 to 10 years of needing the money, your strategy should shift toward protecting what you've built. A significant loss at that stage is much harder to recover from. A rough starting point many advisors use. Let your age guide the percentage of your portfolio in more conservative assets like bonds. At 30, that might mean 30% bonds and 70% stocks. At 60, closer to 60-40. It's not a rigid rule. It's a framework to think from. The other question worth asking is simply, what is this money for? A down payment you need in 4 years calls for a very different approach than retirement savings you won't touch for 3 decades. Get clear on your goal, your timeline, and your honest relationship with risk. Not just what you think you should feel, but what you actually feel. So let's bring this all together. Invest because inflation is quietly eroding your savings, and compound growth rewards patience in a way that very few other things in life do. Open an account, a retirement account if your employer offers one, a regular brokerage account for everything else. Fidelity, Schwab, and Robinhood are all solid places to start. Buy a broad market index fund. A simple S&P 500 ETF gives you instant diversification, low fees, and a track record that spans decades. You don't need to pick winning stocks to build real wealth. Invest consistently. Set up automatic contributions. Remove the decision from your routine, and let time do the heavy lifting.